Joining us now, Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. Always good to have you on and on set as well, Amy. And you prove almost every time that I don't know whether tails wag dogs or dogs wag tails, because you have almost convinced me that tails can wag dogs, or at least they can certainly indicate whether the dog's happy or sad or what. That shouldn't be a surprise. We got your volatile pothole that you talked about last time that you were on. And the VIX is what you said. It's so quiet that something is too quiet, as they say in movies and stuff. And it did. It ran up. Are we done with that?
I don't think so. It's a little bit like when your kids are too quiet. You start to get a little suspicious. Something's going on. It's worse than when there's noise. But look, one thing we talk about in the options world is this idea of sticky skew. And just to translate that, it's this idea that usually when there's a lot of hedging, people, perhaps they're saying things are bearish, I want to protect my portfolio. But then when we do get the down move and those hedges haven't moved, what does that mean? So one interpretation is that folks are actually still bearish, even after we've kind of gotten a downdraft or a multi-standard deviation move. That part's what concerns me, Joe, because we still have that sticky skew. We still have pretty high demand for hedges. None of that has changed at all. Despite kind of the turmoil we've seen recently.
Yeah. You talk about generational investors, I thought was interesting. And you always talk about left tails and right tails. So the right tail is when you're worried about FOMO, about missing out. Yeah. Left tail is where you're scared, you're anxious, you're worried that it's going to go down more. So people that were born before the great financial crisis are more, they know what can happen. And maybe they see things like those credit hiccups that we had in the last couple of weeks. They see those and they immediately start worrying it could be something bigger. Whereas people born after the financial crisis are like, oh no, I'm going to miss the next, Mag 7 move.
Yeah, I think that people sometimes laugh this off as just, okay, so people of a certain generation might say this, but it's really so evident in the market that I think at least the institutional investors we speak to, they've really had to start paying attention to it. Because retail has been so unbelievably resilient. You could argue they won the first round April 2nd when we had a huge velocity in that V-shaped recovery. Right now, you continue to see resilient retail buying, even as institutional investors, I would argue, have been very reluctant in this rally. They can't miss out because there's concentration risk to that, but they've never stopped being bearish. And to me, it's always you're anchored to your personal tail. My personal left tail was the global financial crisis. I was in the market before that. I saw that. And I think folks who I speak to who kind of say, this has a little inkling of '07 when the first Bear Stearns funds started to show cracks. But those who are maybe 2010 and on, they would tell you, well, the lesson of the market is every time that we do get a sell-off, like a COVID, what happens? You're supposed to buy the dip. So those two things have really been in tension. My question is, what breaks that? So we're in this battle right now.
Who's the smart money and who's the dumb money?
And I would say that has flipped. Frankly, the smart money is the money that's making the money.
Right. Does it last? I mean, it's huge questions about that. We had Charles Schwab in last week, and they were talking about how younger investors are a huge part and a bigger part and growing part of their business. That's where they're seeing all the growth, because these are the people who want in the market.
And they're clearly in the buy the dip camp. My question is, it's a little self-referential in the sense that, this stat always gets thrown around that 10% of earners are the ones who are doing 50% of the spending, right? So just in general, a lot of that is tied into stock market wealth. I think if we get a garden variety drawdown, which we have seen, you still get that steady buy the dip. My question is, what happens when you get multi-standard deviation drawdowns? Like at some point, does someone blink? Because my concern is, the institutional community has always been ready to hedge. A lot of that flow, I think, actually looks hidden because of this issue of FOMO. But if we got a 10% drawdown, I actually think a lot more hedges step in. So that skew is actually sticky. It doesn't melt away that it typically does during market drawdowns.
I mean, every dip has, I don't know, going back to 1980, we've been able to buy it. And I was just disturbed thinking about the last time we had a 10-year period where stocks were lower at the end of a decade than they were at the beginning of. We haven't had anything like that since the 60s or 70s, I don't think, have we?
No, and you know what I would
What
tell
about
you?
87? Maybe 87?
It's just how long you, because I would argue that like from '07 to '09, obviously, the right move during the global financial crisis was to buy these names that had good valuation and were trading down because of correlation, but it didn't feel like that at the time. It's
Never
very
does,
psychological, right? Like it wasn't like a April 2nd and then it was over. It took months, and so the question is, do folks have the stomach for that when this is your first rodeo with a true crisis?
Right. And Andrew, since, I always reference both of you, but this might mean more to you because the incestuous nature of AI is not being, you call it that, right? You call it incestuous, but it's not.
You mean the circular deals?
The circular deal. It's not
I
being,
think I wrote incestuous.
it's not being reflected. Maybe, is it not? Is it okay, or is it not? I would think it just looks like 10 overvalued cats for five overvalued dogs, or something like we did in 1999.
So the issue is, and I call it incestuous, but I think everyone knows just
know
what I
you
mean
mean
in terms of the circularity, but the intercorrelation, so essentially the actual relationship between either the Mag 7 names or a basket of AI names is actually quite low. So the way the market is pricing it is that these are still kind of independent silos. And the reality is it's not. We all intuitively know that. So the issue is correlation is ultimately a big component of volatility. And we've had very, very, very low correlation. The way that derivatives traders think of it is almost as its own thing. But when that spikes up, all volatility will reflate. And you haven't, again, see that reflected in the market. Now that we've called it a paddling duck market for a while, but it's because of this idea that it seems very calm, very smooth. But those little duck feet, they've been churning. And, we've been joking at some point, does the duck just flip upside down?
Or do you see rapids ahead? I guess the water on the surface becomes much rougher.
And we saw that a little, right?
Very quickly, they're playing us out. But what happened with gold yesterday?
I think it was a little just profit taking. We actually saw reloading in some of the derivatives markets, so it's a question of the FOMO continues or not.
FOMO continues.